Okay, let's unpack this. We are diving into a market shift that honestly presents a real paradox.
It really does.
It's a story told in these really stark numbers. A massive increase in creation happening at the exact same time as a dramatic decrease in consumer spending. We're tracking the definitive data pivot observed in the NFT space in 2025.
And I think it's crucial we approach this not as a funeral for the technology, but as a severe and frankly unnecessary market evolution.
Right.
If you only listen to the headlines, you'd assume the entire sector just collapsed. But the sources you shared with us, they reveal a critical pivot point. NFTs are rapidly moving from these purely speculative assets.
The digital gold rush we all remember.
Exactly, that volatile period. They're moving from that to what we're now calling digital wrappers anchored around verifiable real-world value.
And that's really the core mission today. We need to go beyond the noise and, dig into the hard numbers behind this seismic shift into the high-volume, low-price market phase. And most importantly for you, the learner, we need to extract the actionable playbook for success, especially when we look at the winning countertrend, the tokenization of physical art.
Well, the hook here is that the whole narrative of NFTs are dead it's misleading. The data shows that liquidity, the available cash, it didn't just disappear entirely.
It just moved.
It retreated. It simply retreated to demand higher quality, clear utility, and verifiable proof. So today, we're going to show you exactly where that speculative money evaporated, why the supply simultaneously just exploded, and why disciplines like the physical art strategy became the required approach against this backdrop of market dilution.
Let's jump right into the cold metrics and the ones that really define this new reality.
Let's do it.
So we started with a data dive because the contrast between supply and sales behavior in 2025 it's nothing short of shocking. We're comparing the market performance in 2024 against 2025 to really illustrate how quickly this all changed.
For anyone tracking the financial picture, it looks like a painful, drawn-out crash. We see a V-shape in reverse. Production volume shoots up, market value just drops sharply. This isn't a cyclical dip,
No.
It's a fundamental change in how buyers perceive and really how they utilize the technology.
So the big picture confirms it. We've moved decisively into this high-volume, low-price reality. Creators, driven by, technological ease and maybe a bit of denial, minted more than ever before.
So much more.
But buyers, having been burned by previous hype cycles, they spent dramatically less per item and less capital overall.
Let's quantify that wallet drain, because this is the first crucial metric. Total NFT sales fell, and they fell significantly. In 2024, the market recorded a pretty robust $8.9 billion in sales.
Which is a healthy number by any standard.
A very healthy number, but by 2025, that figure had plummeted to $5.63 billion. That is a staggering 37% contraction in total spending power.
When you talk about a 37% drop, we're not just talking about a little pullback. That kind of massive reduction in available capital, it signals that the big institutional speculators and the casual flippers,
The fast money.
right, the money seeking fast, easy returns, they have largely departed the ecosystem. They moved on to the next shiny thing, leaving the market to, the long-term builders and the true believers.
This is a massive flight of capital. I mean, to put this in perspective, imagine a large segment of the tech market losing more than a third of its funding overnight. That money wasn't reinvested.
It just left.
It just left. And the money that remained became incredibly discerning.
And what of the money that was spent? I mean, it was spent more cautiously or, as the data shows, on dramatically lower value items. This leads us to the second metric you pointed out, price compression.
Absolutely. The average sale price slipped sharply, and this confirms the cooling of speculation. The average price in 2024 was hovering at about $124.
Okay.
By 2025, that average price point was down to just $96. That $28 drop, while it seems small in absolute terms, it signifies this massive psychological shift in what the average collector is willing to risk on an unproven digital asset. It's the difference between buying a small, unique piece and buying something that just feels like a commodity.
And this is where the historical context is so vital for the learner. Let's anchor that $96 figure.
Let's do it. Remember the chaotic euphoria of 2021 and early 2022?
The peak.
The true peak of speculation. The average price of an NFT back then was closer to $400.
400.
So we are now operating in a market where the average item sells for less than a quarter of its peak value.
Less than a quarter.
Mhm.
So what kind of assets are absorbing that new $96 average price point? What's being sold for that?
Generally, they are utility-focused items. So entry-level gaming assets, very small PFP collections, or maybe low-edition prints from lesser-known artists. The high-value, high-speculation assets, the ones that pulled the average up to $400. They've almost entirely moved to private sales, or they've just ceased trading altogether. This $96 average is the market saying, I will only pay utility prices, not lottery prices.
That makes so much sense.
Oh.
Okay, the third metric that truly drives home the scale of this contraction is the market capitalization. This is vital to understanding the depth of the challenge. So for our learner, market cap is basically the total perceived value of all circulating assets in the market.
And that total value shrank dramatically. At the end of December 2024, the market cap was approximately $10.8 billion.
Okay, still a big
A
number.
very big number. But by the end of 2025, that total value had collapsed down to about $2.4 billion.
An 80% contraction in market value in a single year. That sounds like a depression in any other financial sector.
It is a catastrophic loss of perceived value. I mean, if this happened to a major stock sector overnight, it would be headline news for months. And we also have to remember the true historical peak.
Right, which was even higher.
The market cap was roughly $17 billion back in April of 2022. So the 2025 market is operating at a tiny fraction of that former scale. What this means in practical terms is that for every remaining dollar, the competition for attention is exponentially higher. Liquidity, the ease with which you can sell your asset, has become extremely tight.
So if I'm an artist or a gallery, my project isn't just competing with other new projects. It's competing with this enormous historical inventory that has lost 80% of its value and is desperately trying to find a buyer.
Precisely. This competition for the remaining $2.4 billion in market value completely redefines the necessary strategies for success. You can no longer afford to be generic.
Now, here's the true paradox. I mean, that massive 80% drop in market value and 37% drop in sales occurred at the exact same time that supply just exploded. This is the definition of a diluted market, where demand dries up, but production accelerates.
This is the critical counterintuitive data point that separates the NFT correction from a typical economic slowdown. While buyers retreated, creators accelerated. We saw the total NFT supply grow by a massive 25% year over year.
25%.
The inventory went from 1.0 billion NFTs in 2024 to an eye-watering 1.34 billion NFTs in 2025.
Why? I mean, if the money is leaving, why did producers keep producing?
It's technological momentum primarily. Minting costs just plummeted thanks to technological improvements. More efficient Layer 2 solutions, cheaper smart contracts, and simplified tools meant the barrier to entry for creating an NFT was essentially zero.
So it's just easy to do.
It was easy and cheap, and creators who had already invested time and effort felt compelled to keep launching drops, hoping to catch the next wave, even as the previous wave was receding.
That's like a factory that finds a way to produce goods 35 times faster and cheaper, so they just keep the machines running, even as the general consumer market only has a quarter of the money to spend.
That is an excellent analogy, and if we look at the deeper trend, the growth rate since the initial boom is truly staggering. It emphasizes the magnitude of the dilution.
Lay out that historical arc for us again, because the numbers are unbelievable.
They are powerful. In 2021, when the market first caught fire, we had 38 million NFTs in existence.
Okay.
That ballooned to 106 million in 2022. Then it exploded to over 550 million in 2023. By 2024, we reached the 1 billion mark, and now 1.34 billion in 2025.
That's an increase of approximately 3,400%, or 35 times the inventory, in just 4 years. And all of that inventory is competing for attention in a market that has shrunk by 80%.
And if we connect this to the bigger picture, the sheer volume is the single most important factor driving the new market mechanics. It means that attention and liquidity, the buyer's money and the buyer's focus, are being stretched incredibly thin across an enormous, rapidly expanding inventory. Every new project is born into a sea of 1.34 billion immediate competitors. No project, no matter how good, can survive that kind of dilution without clear, defensible differentiators. So we have the statistical summary. Sales down 37%, average price down to $96, market cap down 80%, but supply is up 25%. The fundamental question is, how do you, the learner, navigate this? We need to decode the underlying mechanics of this intense dilution.
I have to pause here and ask the skeptical question. If I'm a rational artist looking at an 80% market cap collapse, why should I even bother minting? I mean, isn't the risk simply too high?
That's a valid question, and it's exactly the friction we need to explore. The risk is high for generic projects, but the potential is still immense for quality. The reason to bother is that the utility of the technology, the ability to provide immutable proof of ownership, trackable provenance, and instant global transfer, that hasn't diminished.
So the tool is still good?
The tool is better than ever. What has diminished is the value of the speculative asset. The opportunity now lies in using the technology correctly, linking it to assets that already hold value.
Let's get back to the initial dynamic then. We established that the supply increase was driven by technological ease. Minting just became vastly easier and cheaper over those 4 years.
Correct. The technological barrier to entry for creators just evaporated. It enabled artists, brands, and hobbyists to keep producing drops almost continuously, often relying on automated tools, and this created massive, undifferentiated noise.
But technology can only solve the production side. The bottleneck immediately appeared on the demand side. So let's define liquidity simply for our learner.
Okay, think of liquidity as the available cash flowing through the market, and critically, the ease with which you can convert an asset back into cash.
How quickly can I sell it?
Exactly. When sales fall 37% and the total market value shrinks 80%, liquidity dries up. It becomes hard to sell anything quickly. So buyer liquidity, the available cash in collector wallets, and buyer attention, the ability to focus on and discover new projects, they did not scale at the same pace as the supply.
So we had an infinite spigot of supply meeting a finite and shrinking pool of money and focus. The consequence of this radical oversupply, as you put it, is brutal efficiency.
That brutal efficiency is the market instantly weeding out low-effort or poorly conceived projects. They are instantly lost in that 1.34 billion inventory flood. The market became unforgiving to projects lacking three critical defensible elements.
Okay, what are they?
First, a sharp concept that differentiates them immediately. Second, verifiable authenticity that guarantees their origin and history, which is especially vital now. And third, clear buyer incentives, which is what we mean when we talk about tangible utility. If you lack these three, your project essentially has a price floor of zero.
It's the digital equivalent of every gas station suddenly stocking 1,000 types of artisanal soda. As a consumer, you're overwhelmed, you have less money to spend, and you only buy the one flavor you absolutely know and trust.
And the other 999 options just disappear.
They disappear into inventory obscurity.
That analogy perfectly illustrates the dynamics of dilution. And the critical takeaway here is that the drop in sales does not mean NFTs are dead. It means that speculation cooled significantly. What we are seeing is a market shift toward maturity and professionalism. Buyers now demand demonstrably higher quality and a clearer value proposition before committing their limited funds.
So this defines the requirement for creators who want to win. I mean, the age of the lazy drop, the quick generic mint, is definitively over because those drops get diluted instantly by the sheer volume. What must winning projects lean into now to cut through 1.34 billion competitors?
They have to deliver substance. They must prioritize four things. First, provenance. This is the documented history of the asset, its origin, creation process, and chain of ownership. It has to be clear and trackable on the chain. Second, storytelling. The narrative around the project has to be compelling enough to cut through the noise, connecting the artist or brand to the buyer on an emotional or intellectual level. Third, utility. A real-world function or benefit that goes beyond just holding a digital image. This could be access, rights, or tangible perks.
And the last one.
And fourth, real-world credibility. This is paramount, especially when tokenizing physical assets, where traditional markers of trust like gallery backing or professional authentication still matter immensely.
This brings us back to the practical response for creators. Stop viewing NFTs like lottery tickets. You have to treat them more like digital wrappers around real assets and real communities. It's about anchoring the digital token to something tangible and verifiable, something that existed before the blockchain.
Exactly. The token's value doesn't come from its digital scarcity alone, which we've seen is easily replicated. Its value comes from being the verified, immutable certificate, the mechanism for transferring rights, or the membership card to a community centered on the actual physical asset.
This transition is perfect. In a market where digital scarcity has been proven illusory by the 1.34 billion mints, true scarcity and credibility are paramount. This is why the tokenization of physical art became the winning counter-trend. Physical art possesses these inherent advantages that digital native art often simply cannot replicate at scale.
Right. Because when the average price for purely digital speculative assets collapses to $96, collectors instinctively look for assets that possess built-in, unshakable value anchors. Physical art provides that structural integrity. It leverages existing trust frameworks and wraps them in blockchain efficiency.
Okay, so let's break down these inherent advantages that provide a competitive moat against the flood of digital dilution. The first one is obvious, but I think it's often overlooked in the frenzy. Natural scarcity.
The digital market suffered because supply could be infinite or at least massively inflated. A physical original, by its very nature, is a leaven asset.
One of one.
That's it. And even if an artist produces physical editions, those editions, say 50 prints, are naturally limited by the physical materials, the time, and the artist's discipline. This inherent natural scarcity cuts through the noise of overproduction instantly. It's a built-in scarcity signal that speculators cannot replicate easily.
Advantage number two. Story and provenance. You defined provenance earlier as the documented history of the asset. Digital native art often has these short, shallow histories minted and sold within a week. Physical art, if handled professionally, comes with a rich, documented history already.
And this documentation is the trust signal collectors are desperately seeking. We're talking about details that take time to accumulate. The artist's background, the medium used, the specific creation process, and most importantly, the exhibition history and a full chain of custody. This verifiable history translates directly into trust, a commodity that has become the highest priority for buyers in this post-speculative era.
So when a buyer looks at a physical art NFT, they aren't just looking at the image. They're looking at decades of verified context and history that the NFT simply certifies.
Exactly. It's the difference between buying a mass-produced digital replica and buying a verified vintage artifact.
Advantage three. Real-world value anchors. The physical art market has been around for centuries. Collectors already understand and trust galleries, auction houses, and traditional documentation processes like appraisals and paper certificates of authenticity.
And that existing framework drastically reduces the mental friction for the buyer. Tokenization simply adds an immutable layer of security and transferability to that existing trust structure. You aren't asking the buyer to trust a brand new digital concept. You're asking them to trust an existing piece of art, enhanced by blockchain technology.
And finally, the fourth advantage is the better fit for utility. In this high-volume, low-price environment, utility is what justifies the price.
Because the physical item exists, the token can easily and verifiably grant access or rights related to that physical item. This is real utility. The token can function as the on-chain certificate of ownership. It can guarantee exclusive access to the artist's next physical studio viewing, or, crucially, it can grant clear, defined commercial licensing rights related to the physical work. The utility is anchored to reality, which makes it tangible.
It's the shift from buying a speculative image to buying the verified, legally documented claim on the object, validated by the NFT.
Ultimately, the core strategy boils down to a clear trade-off dictated by that plummeting average price. If the average buyer is now only spending less than $100 per NFT, creators simply must compete by offering more substance. We call this offering more reality per token.
That's a great concept. It means volume is no longer the metric of success. Density of value is.
That's the entire game now. If you are selling a generic digital item, you are competing against 1.34 billion other generic digital items. If you are selling an authenticated, scarce physical asset with a clear history wrapped in a token, you're competing in a much smaller, higher trust, and higher value market segment.
So, to drive sales in this challenging, high-volume, low-price environment, what minimum documentation must be included? What do you need to offer?
The required offering must include clear rights documented on-chain, meaning the terms are visible and immutable. It requires verified origin documented through exhaustive metadata that mimics gallery standards. And most importantly, it needs collector-grade documentation that rivals the rigor of a traditional sale. The NFT is the proof, but the physical art provides the deep, resilient value.
We've established the why the market is diluted and demands reality. So now let's move into the how. This next section is the practical playbook, detailing the 6 steps an artist or gallery needs to take to successfully tokenize physical art. This is highly actionable for the learner aiming to transition into this specialized space.
And success in 2025 and beyond is less about technical brilliance and more about operational discipline and credibility signals. If you skip any of these 6 steps, you are effectively putting your project into that lazy drop category destined for instant dilution and failure.
Step 1. Digitizing. like a collector in stacks. Most artists, I think, transition to NFTs using low-effort phone photos or hurried scans. But to confer high value, the digital media representing the physical piece has to be meticulous. It has to meet the standards of serious physical collectors who might be purchasing sight unseen.
This is non-negotiable professional discipline. You need high-resolution scans or professional controlled light photography. And what does controlled light mean? It means ensuring no harsh reflections or shadows distort the texture or the accurate color of the artwork.
Right.
If I buy a painting expecting deep reds and it arrives as faded pink because of poor lighting in the photo, the token's value just collapses instantly due to misrepresentation.
And what about the detail shots? Why are those mandatory?
Yeah. Detail shots, close-ups of the texture, the artist's signature, the edges of the canvas or paper, they are mandatory because they serve as visual evidence of authenticity and craftsmanship. They allow the collector to inspect the work digitally just as they would in a gallery.
I see.
Furthermore, we strongly recommend a short studio-proof video of the piece being created or verified by the artist or a trusted third party. That video acts as a powerful, non-replicable trust signal.
Okay, so step 2 is packaging provenance. You're saying this is your competitive edge in a diluted market. Verifiable documentation builds trust signals that generic PFP projects simply cannot replicate.
The Certificate of Authenticity, or COA, is absolutely essential. It must be generated professionally, signed, and then its details. The COA ID number, date issued, and authentication details must be anchored securely in the NFT's metadata.
And beyond the COA?
Beyond the COA, the metadata must be exhaustive, meeting traditional art standards. The edition number, the exact size in professional units, the year of creation, the medium used, and crucial condition notes about the physical piece.
Why is that detailed metadata so important?
It creates a permanent documented history that the token simply points to. You also need to include the artist statement and any existing documentation, such as exhibition history, press coverage, or prior verifiable sales data. By linking this entire package to the token, you transform the NFT from a speculative image into a certified, historically documented financial instrument.
Okay, step 3 requires laser focus. Define what the NFT actually grants. The source material emphasizes that oversupply punishes ambiguity because buyers retreat immediately from uncertainty. Clarity in the utility offering is paramount.
Yes, creators must move beyond those vague promises of future alpha access or metaverse integration. You have to clearly spell out the legal rights that transfer upon sale. We need to distinguish 3 things.
Okay.
1, token ownership. You own the digital certificate on the blockchain. 2, physical ownership. You own the physical object itself, if it's redeemable. And 3, copyright licensing. You own the legal right to reproduce or commercially use the image.
And most collectors probably assume that buying the NFT gives them all 3.
And that is a dangerous, catastrophic misconception. You must be explicit. For example, you need to state, is the buyer just getting token ownership? Or does a limited commercial license or even full copyright transfer as well? These are very different legal concepts, and the buyer demands certainty, especially when they're spending hundreds or thousands of dollars.
And the redemption question is critical.
Yes. You must state explicitly whether the NFT can be redeemed for the physical artwork. If it is redeemable, what are the precise terms, costs, and timeline for that process? If it is purely a fractional ownership token, that must be crystal clear. Ambiguity is the enemy of trust.
Beyond rights and redeemability, you mentioned you need tangible collector perks.
These tangible benefits attach real-world utility to the digital asset, and they boost its perceived value far above that $96 average. They shouldn't be abstract. Think specific. A guaranteed dinner with the artist, access to private, pre-sale drops of future physical works, granting limited print rights for personal display, or guaranteed VIP access to their next gallery event.
Okay, so step 4 is minting with disciplined supply. We spent the first 2 sections talking about the inventory flood. Discipline signals seriousness and respect for the collector in this exploding market.
This is where physical artists often intuitively succeed over digital native artists. The rule is simple, and it mirrors the traditional art world. Use 11 tokens for true, unique originals.
1 of 1.
And for prints or derivative editions, keep the editions tight. The sources suggest a range like 25 to 150. This creates scarcity.
And why avoid large drops like 10,000 editions?
Because it's inflationary. Minting 10,000 immediately signals you prioritize volume over scarcity, and in a market flooded with 1.34 billion tokens, the value immediately spirals toward that $96 average. You should only attempt drops of that size if you are a major established brand with proven distribution capabilities that can actually absorb that inventory volume. Discipline is a direct signal of projected scarcity and quality control to the discerning collector.
Step 5 is arguably the biggest pivot for artists. Distribution must be prioritized over minting. We see so many technically flawless projects fail because the artist assumed if I build it, they will come.
The mantra has shifted completely. You must aggressively reach out to existing collectors and communities. This requires focused effort on collector outreach, which means leveraging traditional gallery connections or existing high-value clientele. You need formal gallery partnerships that lend credibility and engage existing communities that already appreciate the style or artist. This is sales, not just coding.
And distribution requires a continuous professional effort. It's not a one-off thing.
No, it's consistent marketing. Cross-posting stories, sharing that behind-the-scenes content that proves the provenance we discussed, and maintaining a professional drop calendar. And crucially, you must provide secondary market support. This means ensuring there is clear, consistent metadata and a professional, consistent collection page on all major marketplaces, so the asset retains its value and visibility long after the initial sale.
Right, because if the secondary market looks like a mess, no one will buy the primary piece.
Exactly.
Finally, step 6, and this addresses the complexity of executing all 5 prior steps with rigor. Using an NFT partner for execution and messaging. For credibility and seamless execution, partners can provide essential strategy, positioning, and go-to-market support that an artist or small gallery often lacks.
This is where discipline and professional execution converge. The sources mention Hoken as a prime example here. Their focus is connecting brands to people through NFTs, leveraging this globally and economically for digital monetization. Their expertise extends far beyond just hitting the mint button.
Their role seems to be less technical and more strategic project management.
Precisely. Their experience suggests a focus on overseeing all project phases, from collection management to integration with potential Web3 video games or managing exclusive access via NFTs. Collaborations with high-profile artists like Juan Tardivo and institutions like the CEA Foundation demonstrate that they understand the necessity of institutional trust.
Why is that partnership focus on authentication so critical right now?
Because when credibility is the market's #1 priority, the partnership's emphasis must align with the collector's demand for verifiable proof, provenance, and trust. A professional partner helps you execute the trust signals we just discussed, meticulously documenting the COA, ensuring legal clarity, and implementing disciplined supply controls, which is something a solo artist might overlook in the rush to launch.
This has been incredibly dense, detailing a major market shift from speculation to substance. So let's use the frequently asked questions to solidify these concepts and provide definitive, clear answers based on the data we've reviewed. This is where the aha moments happen for the learner.
And we need to clearly delineate what changed from the boom years, which I think still influence many people's perceptions of NFTs.
First, let's tackle the headline. Is the NFT market dead? What is the definitive answer based on the 2025 data?
No, absolutely not. The speculative fever is dead, but the market itself shifted and matured. The data confirms a decisive move from high-risk speculation to a high-volume, low-price reality that demands quality and verifiable value. The weak projects died or flatlined. The required standard for quality just increased exponentially.
So if the market is demanding quality, what kind of art performs better now in this climate of oversupply and shrinking liquidity?
The market rewards work with a strong identity, verifiable provenance, clear rights and utility, and, above all, consistent release discipline. Crucially, physical art tokenization naturally fits this description because it provides those innate scarcity and trust signals that the digital market now desperately craves to justify any price above that $96 average.
This next question is the most practical for any creator planning a launch. How do I price when the average sale price is $96? Should I just list everything below $100?
You should use that $96 figure as a reality check, not as a rule. It tells you that the bulk of available liquidity is focused on low-entry speculation or small utility items. You absolutely must implement a tiered pricing strategy that is tested in phases.
Tell us about that structure. What would that look like?
You need entry-level editions, perhaps slightly higher volume, price for discovery, to onboard new users and introduce them to your community. Then you need premium 11s for your high-end collectors, priced based on traditional art market valuations, anchored by the physical asset.
And what about bridging the gap between those two?
That's where you maximize value. Bundles tied directly to physical ownership, access, or licensing. Those are where the real value and the higher price points will reside. Don't overcommit on pricing on day one. Start conservative and let the market show you where the value ceiling is based on the quality of your provenance package.
Okay, let's talk legal details. This is essential given the focus on rights and utility. Do NFTs automatically give the buyer copyright?
Almost universally, no. This is a common and financially dangerous misconception. Copyright, the exclusive right to copy, distribute, and monetize the artwork and licensing, depend entirely on what you explicitly grant the buyer. You must be crystal clear.
If I am a learner, what's the simplest way to think about the difference between owning the token and owning the copyright?
Think of the NFT as the ticket stub for a museum, not the ownership deed of the museum itself. You own the ticket, which proves you participated, and perhaps it grants you exclusive entry to the gift shop. That's the utility. But you don't own the masterpiece inside or the right to print copies of it. Unless you explicitly state in writing that a certain license transfers with the token, the copyright almost always remains with the artist. For high-value drops, legal review is strongly recommended to avoid catastrophic misunderstandings with collectors.
Okay, so finally, for the artist or gallery looking to enter this space, how do you make your art NFT trustworthy in a skeptical post-hype environment?
The market now rewards explicit trust signals over manufactured hype every single time. It's about minimizing the cognitive load for the buyer.
So what does that look like in practice?
That means you must document the creation process meticulously, as detailed in the playbook. You must keep consistent metadata, the digital fingerprint, across all releases, confirming that the digital wrapper is consistent and reliable. You need to publish clear edition rules up front, demonstrating your discipline and commitment to scarcity. And always, always provide verifiable provenance and proof of authenticity linked directly to the physical asset. Trust is not a bonus. It is the new essential currency in the high-volume, low-price market.
So what does this all mean for you, the learner, navigating this fundamentally shifted landscape? The 2025 data confirms the NFT ecosystem has matured rapidly, shedding the majority of speculators and ruthlessly rewarding clarity, discipline, and verifiable value.
The new winners are definitively those who anchor their digital assets in verifiable reality, backed by structured, rigorous documentation and professional execution. The key question has moved from the speculative, can I mint this easily and flip it quickly, to the grounded, does this asset confer real defensible value, and can I prove its history?
The lesson is clear. If you are entering this space today, you are competing not on speed or flash, but on substance and trust.
Which leads us to the final provocative thought. The shift has made the art market less about purely digital scarcity and overwhelmingly more about digitized trust in the physical world. For the learner exploring this space, consider this. If the market keeps rewarding trust signals and verifiable natural scarcity over hype, what other non-art physical assets beyond paintings and sculptures could be next in line for tokenization? Which items inherently possess the high value, trackability, and deep need for immutable provenance that can leverage this technology?
So things like,
We are talking about things like certified antique furniture, rare historical documents, or specialized luxury goods. That is something powerful to mull or explore on your own as the tokenization trend continues its journey toward anchoring itself firmly in reality.